Together with stocks, bonds are probably one of the most well-known and most used instruments, financial instruments, that we have in order to put our money in the mechanism of economy that we talked about in previous videos. So let's see in this video what bonds are, how they work, but also for which type of investor they suit better. Hey, it's Dario and this is Divity Finance, a platform where we can share our best tips and tools when it comes to trading, investing or finance in general. And if you love the subject, please consider subscribing. Stocks are not always a good option for everyone. When we talk about our financial management, it is very personal. Every person has a different need and therefore they must use different instruments to reach their goal and to meet their needs. For this reason, it is important to have a broad understanding of the major financial instruments that we have in order to understand which to use in our particular case. Let's just remember that it's the goals that we have that define the instruments that we're going to use, not the instruments that we want to use which define the goals. This is very important. So in this video, let's talk about bonds. In a few words, a bond is simply a loan that a company or a government asks. In this case, the loan though is not asked to a bank, but to private investors. It is therefore a very practical way in which the investor have the opportunity to lend their money to companies in a very similar way as banks would do it. As we said in the video about stocks, companies need money in order to grow and be competitive in the market. If a company is not competitive in the market, it's just gonna be a matter of time till it goes bankrupt. Companies could therefore ask money to the bank, but maybe the bank doesn't trust them enough, or maybe the interests are too high. Could issue some stocks, but maybe they did already that. So the next option is to give out bonds, to issue bonds. There are three types of bonds: the fixed coupon bonds, the variable coupon bonds, and the zero coupon bonds. So let's see in this video all these three bonds and what the difference are between them. First of all though, let's understand what a coupon is. A coupon is a certain amount of money that the company or the issuer will give the person that bought the bond every certain amount of time. This can be every semester, every quarter, every year, and so on. This is practically the interest that we are going to receive because we lend our money to this company or to this government. In the case of fixed coupon bonds, the coupon is fixed before the issue of the bond. That means that the person that is going to buy the bond is going to receive the certain amount of money, which is precise, and he knows how much money he's going to receive every month, every semester, every year. And that is going to be that same amount no matter what. Of course, every bond has a certain expiration date. So the issuer is going to give the last coupon at the expiration date, and with the last coupon is going also to give the initial investment that the investor put in. This is a scheme of a 5-year bond which pays a fixed coupon every year. As we can see, the coupon is exactly the same for every single year, and at the 5th year the issuer pays the last coupon plus the initial investment. In the case of variable coupon bonds, the coupon will vary based on a certain rate. Normally this rate, at least for European bonds, is either the Euribor or the LIBOR rate. So the amount of money that the issuer is going to give will vary based on the variation of the LIBOR or the Euribor. This is a scheme of a 5-year bond that pays a variable coupon. As we can see, every year the coupon is different. This is because the rates are different. At the end of the 5 years, so at the 5th year, the issuer will calculate the last coupon that it has to pay and then give back also with the coupon the money that was initially invested. Now we saw fixed coupons, we saw variable coupons, let's now see zero coupons, which means without coupon. These are bonds which, again, as I said, don't have coupons. Or better, they have a fixed amount of money that is going to be paid at the end of the total life of the bond. This amount of money is called the reimbursed capital. Be careful, because the reimbursed capital is the total amount of money that the issuer is going to give back at the expiration of the bond. This means that, for example, the issuer can decide to give $110 for every $100 that he received. An example would be certain Italian government bonds, which have an expiration of 1 year and 0 coupon. With this scheme, we can see how, opposite to the other previous two examples, there are no coupons for the first 4 years. At the 5th year, though, everything is paid at once, both the initial investment and the interest. The summation of the two is the reimbursed capital. And normally the third option is used by governments or institutions, not much by private companies. Okay, Dario, thank you. Now I understand what type of bonds there are and how they work, but how do I buy bonds? To buy bonds, similarly to stocks, there are two options. One is at the issue date, the other one is on the secondary market. And to be honest, in reality, the secondary market is the one that is most used. This is because companies don't issue bonds every single day. So we need to use the secondary market in order to be able to buy bonds whenever we want. But what does it mean, secondary market? If an investor bought some bonds, but he wishes to get back his money because, I don't know, he needs it, he cannot just say to the issuer, okay, you know what, I don't want the bond anymore, give me back my money, because there is a contract. So you cannot do that. You need to sell your bond, your contract that you did with the issuer, to someone else that wants to buy it. We do this on the secondary market. This trade between investors who have different interests, so one investor wants to get back his money, the other investor wishes to invest in that bond, can be done through exchanges similar to the ones for stocks. On the secondary market, though, the price of the bond tends to follow a mathematical formula that includes different variables. This is especially true for the fixed coupon bonds. This is because the coupon is precise and known from here to expiration date. In this video, of course, we will not see the mathematical formula because it will take me half an hour just to explain it. But let's see the three most important variables that are contained in the formula. One is the market interest, so basically the interest connected to the central banks. The second one is the risk connected to the company, so the risk of the company failing, or the issuer more in general, because this is also for governments. And the third one is time. But how can these three variables influence the prices of the bonds on the secondary market? In general, we can say that when we have increasing interest rates from the central banks, the prices of the bonds on the secondary market will tend to go down. On the other side, when the interests decrease, then we will generally have the price of the bonds increasing. So it's an inverted correlation. This makes us understand that an investment in bonds in a period of very low interest rates, where the interest rates have a high probability of going upwards in the nearest time, is an investment that is very dangerous and could potentially destroy our portfolio. This is because if the interest rate should increase, and because they are low, they have a high probability of increasing, then the prices of bonds could drop. And with the drop of the bonds, our portfolio is going to drop as well. As we said earlier, the coupon is decided upon issue. This means that the coupon has no way that it can change during the life of a bond. For variable coupons, the formula is decided, but that formula cannot change regardless of the course of the bond. What can change though is the yield of the bond. To understand this, let's imagine that one investor buys the bond at the issue date. Let's say it buys it at $100 and the coupon, let's say it's a fixed coupon, is of $10. This means that the yield of the investor is 10%. So the interest that he is going to receive is 10% of its investment. After 1 year, this investor decides to sell its bond on the secondary market for $105. This investor that bought the bond at $105 will still have a coupon of $10 and not 10.50 cents. This means that its yield is now 9.5% and not 10% anymore. To calculate the return or the yield, It's very simple, it's just the coupon divided by the price that you bought the bond at. The issuer risk then influences the prices of the bonds on the secondary market with an inverse proportion. This is because if the risk of the issuer increases, the investors will ask for a higher and higher yield in order to take that risk. To increase the yields of a bond, though, the price of the bond itself on the secondary market needs to drop, so that the coupon divided by the price at which I buy the bond at is going to increase, which is the yield. On the contrary, if the risk of the issuer drops, the prices of the bonds will tend to increase. This is because the investors will accept less returns, so less yield, and they will be willing to pay even a little bit more and have a little bit less yield just to have that bond, because it's at a lower risk. How many times have you heard about the performance of the treasury bonds increasing or decreasing? Treasury bonds are government bonds issued by the US. If the US becomes riskier, so less and less able to pay its debts, the market is going to perceive it as more risky, and therefore the yield is going to increase, and the price of the bonds will decrease. If the US becomes more and more able to pay its debts, the investors will perceive it as less risky of an investment, so they will accept lower and lower yield, so the price of the bonds will increase. Of course, this is not the only reason why the yields of bonds change and the prices of bonds change. As we said before, there are other variables, but this is one of the most important ones. Also, the perception of the risk of the issuer is then influenced by other aspects, such as geography, the local economy, the region, the sector of a company, for example, and so on. Finally, we must consider the last aspect, the time, which rather than influences the prices directly, it simply widens, amplifies its movements. So the further the maturity or the expiration date of a bond, the more amplified will be the swings of up and downs in the bond's price. This means that, for example, if I have a 30-year bond, if the interest rates will go up, the price of the bond will decrease drastically. On the contrary, if I have the same exact bond which expires in 5 years, I will have the prices of the bond dropping but less violently. So why should I buy bonds? What is the difference between bonds and stocks? The most important difference is the risk. Shares don't expire, so the prices of shares increases and decreases throughout the entire life of a company. Bonds, on the other side, have a fixed date of expiration. At that date of expiration, your money is going to be given back, no matter what, unless the company or the issuer fails, of course. Also, if you buy bonds of big companies or important government or important countries, the risk of failing is so low that the investment is quite safe. Of course, if the investment is quite safe and the risk is very low, also the potential gains will be quite low. In addition to the well-known diversification, though, we have another thing that we can use in order to lower the total risk of our investment. That's time. The more time we have in order to invest, the most riskier investments we can make. This is why, for young people as me, stocks are probably one of the best investments, because we have a lot of time. But when I will get older and when I will get near to retirement, I may want to consider to switching my portfolio from stocks to bonds. This is because I don't want to be like 2 years before retirement seeing my stocks portfolio dropping 40%. So bonds are probably a good investment for all the people that are very near to retirement, and they should consider switching from stocks to bonds. Such as for stocks, also for bonds we have ETFs. So it's always better to go with the diversification that ETFs give us instead of choosing single bonds. So if you don't know how to choose ETFs, I made a video on how to choose ETFs. In any case, in these days it's very hard to find good bonds. The bond market is not that good. This is because for short expiration date, the yield is very low. And if we want to find a decent yield, we have to go to longer maturities, which means more risk, as we said before. So this is another thing to keep in mind. We recently talked about stocks and we said that stocks are exchanged on exchanges. And also we said this about bonds in this video. So in the next video, let's see what exchanges are, how they work, and how they were created. So if you don't want to miss out on any further video, I highly suggest you subscribe to the channel right now so that you can be up to date with everything I post new. In any case, I will see you in the next video.